Question 4 is on consolidated financial statements. So I'll read out the question as usual. NED PLC, Nelly PLC, Nana PLC, and Ichewon Limited statements of financial position 31st December 2024. So we have the asset side of the companies, and the total is 2,450,000,000 for NED PLC. For Nelly is 1.5 billion. For Nana is 800 million. And for Ichewon is 70 million. On the equity and liability sides, we also have equity, and then we have non-current liability and current liabilities, which also total the same. Note 1. NED PLC acquired 85% of Nelly shares, 30% of Nana PLC, and 25% of Ichewon Limited at 900 million, 280 million, and 20 million respectively. Nelly PLC acquired 50% of Nana PLC when the retained earnings were 300 million at 400 million. When NED PLC acquired Nelly PLC and Nana PLC, retained earnings were 200 million and 150 million respectively, while their revaluation reserves were 10 million for Nelly. The share capital of all the companies have been unchanged since acquisition. Note 3. Goodwill of Nelly PLC and Nana PLC suffered impairment loss of 5% and 10% respectively. During the year, Nelly sold goods to NED PLC worth 100 million at a markup of 25%. A quarter is still left unsold. 5. Note 5. In the book of NED PLC, their payable to Nelly PLC was 20 million, while Nelly receivables is showing 25 million. The difference is goods dispatched by Nelly to NED that have not been received by NED PLC. 6. Each one made a profit of 60 million and paid tax of 12 million and dividend of 50% of their earnings. Required. Prepare NED PLC consolidated statement of financial position for the period. 2. Using the equity method, compute the value of investment in Ichewon Limited and consolidate in the group. So we have seen the question. The question is about complex consolidation or complex group. A situation where you have the parent, you have the subsidiary, and you have the sub-subsidiary. And then again, you have associates. In this situation, the parent bought shares from the sub-subsidiary directly. The subsidiary also acquired the sub-subsidiary. So the first thing we need to do is to show the group structure. It's on the board. Group structure. We have NED PLC in Nelly. The question said 85%. NED PLC in Nana PLC. Direct involvement is 30%. NED PLC in Ichewon Limited, 25%. Nelly PLC in Nana PLC, 50%. Then NED PLC in Nana PLC, indirect, we have 42.5%. This is what it means is that Net PLC owns 85% of 50% of Nana PLC. Everything that uh, Nelly has, Net PLC owns 85%. So since Nelly acquired 50% of Nana, what it means is that Net PLC has 85% of this 50%. So it will give us 85% multiplied by 50% will give us 42.5%. Then we need to calculate the effective interest rate of NED in Nana. It will be the direct investment plus the indirect investment, which will give us 72.5%. The non-controlling interest will be 100% minus 30% plus 85% times 50%, all in brackets and bracket close, will give you 27.5 or 50%, 27.5%. So now we want to find out control. NED PLC bought Nelly PLC 85%. So that one is already determined that Nelly is a subsidiary of NED PLC. So because he owned over 50% shares. Then here, NED PLC in Nana, only 30%. Ordinarily, as it stands, he does not own Nana PLC. He should account for it using the equity method. But however, his subsidiary also acquired 50% of Nana PLC, which gave him additional power. Now, what it means that in Nana PLC, Net PLC has 30 plus 50, 80% power in Nana PLC. Because Net PLC controls Nelly PLC. So Net PLC will vote is 30% and also vote the 50% of Nelly PLC because he is in control of Nelly PLC. So that 50% shares is available to NED to control. Therefore, it has the power to direct Nelly PLC to vote that 50% in their favor. And they will also vote their 30% in their favor, which means they have 80% power in Nelly PLC. But however, that is not the control they have, because we still know that we have some non-controlling interest in Nelly PLC. And Nelly PLC also have non-controlling interest in Nana PLC. So we need to look at the indirect interest that Net PLC, effective indirect interest that Net PLC has in Nana PLC, which is 80%, 85% of the 50%, which gives us 42.5%. And then the total of it will be this plus this, that we have 72.5%. In each one, NED only has 25%, so he does not have control. But however, he has what is called significant influence. Because he has significant influence, he will only account for his investment in each one limited using the equity method. We demonstrated it in the last question. So the first thing we need to do is to compute our non-controlling interest. We already have a percentage of the non-controlling interest. So we need to compute the value of the non-controlling interest. Of course, our zeros are too many, so we reduce it to thousands. The non-controlling interest of NED in Nelly will be the 15% of the net assets of Nelly. The net asset of Nelly is 1 billion. That's 1 billion. However, Nelly have investment in Nana of 400 million. We are not going to use this 400 million to compute the non-controlling interest because it has already been invested in Nana. So we remove that 400 million. If we take the 15% of it, if we take the 15% of it, we have 90 million. And then we also look at the net assets of Nana. We want to take the non-controlling interest in Nana. The net asset of Nana is 550 million, as the case may be. So that would be 24.5% multiplied by this gives you 1,178,750,000. So if you add all, you have 268,750,000. This is where we will stop for now until we calculate the impairment of the goodwill. Goodwill of Nelly PLC and Nana PLC suffered impairment loss of 5% and 10%. So we must calculate the goodwill first before we'll be able to calculate the impairment. So we can end here and then go to computation of goodwill. Even though I've written it out, it's because I've worked it out. Goodwill computation. As I said, we're going to compute the goodwill in two levels. First, we'll compute the goodwill at acquisition. Then we'll compute the goodwill that is attributable to NED PLC. So we have NED in Nelly, NED in Nana, Nelly in Nana. Purchase consideration is 900,000, 280,000, and 400,000. Of course, these are in millions anyway. You know that it's 900 million, 280 million, and 400 million. So we bring the net assets of the acquired companies. Share capital of Nelly is 550. NED is 200 at acquisition, and Nelly is also, Nana is 200, Nana again 200. We come to share premium, 150 at acquisition, 80 at acquisition, and 80 at acquisition. Then we come to revaluation surplus. We were told that revaluation reserve for Nelly was 30 million. So that is the 30 million that was there at the date of acquisition that we are going to use. We are not going to use the revaluation reserve that is in the statement of financial position, but the one that is in the one that was there the day they acquired the company. What it means is that after acquisition of the company, there were revaluations made that increased it to what it is now, 50 million. That would have been the effort of the acquirers and the acquirees, according to the way it is, because there are more than one acquirer now and more than one acquiree. Then the retained earnings will also do the same thing. At the time Ned acquired Nelly, Nelly had 200 million as retained earning. Even though if you go to Nelly's uh, book, you have 250 million. But what they bought actually was 200 million, not 250 million. So it's only the 200 million that you place here when they are calculating the goodwill. I have taught you group account, so you know what I'm talking about. Then when Ned acquired Nana, they also had only 150 million in their uh, retained earnings. So that's what we bring here. And when Nelly acquired Nana, they had 300 million. That's what we're going to bring. So the total assets, net assets of the companies are at acquisition are like this. For Nelly, at the time it was acquired, it was 930 million. For Nana, at the time Ned acquired it, it was 430 million. And for Nana, at the time Nelly acquired it, it was 580 million. Now, we need to apply the percentage of acquisition in all the companies as at the time they acquired them. So net assets acquired. Ned acquired 85%, so you take 85% of Nelly. This is what it gives you. Ned acquired 30% of Nana, so you take 30% of Nana's net asset as at the date of acquisition. This is what it gives you. And then Nelly acquired 50% of Nana, then you take 50% of this, that's what it gives you. So the goodwill will now be purchase consideration minus the net asset acquired, which will give you 1095 15100 Then goodwill attributable to Ned will be this because it's direct, this again because it's direct. However, this is indirect. So you are going to apply 85% on 110. So what is given us is 93,500. So the total goodwill will be this plus this plus this, and give you 354,000. So that's the goodwill computation. The goodwill computation, we are going to add and minus some things when we do the other adjustments. Okay, we want to also calculate the retained earnings. It's on the board, retained earnings. Ned PLC. We'll take the whole retained earnings of Ned PLC, the parent company. We have 300 million. And then retained earnings from Nelly will be 85% of the post-acquisition retained earnings. Post-acquisition retained earnings. The pre-acquisition retained earnings has been used to compute the goodwill, so you will not use it. So it will be the retained earnings we have in the statement of financial position is 250 million. You will less the 200 million that was there at the date of acquisition. So what you have here is 50 multiplied by 85%, gives you 42,500,000. Then we have retained earning from Nana PLC, the direct acquisition. As at the time Ned bought Nana, the retained earning was 150 million. As at today now, it is 370 million. As at reporting date, it was 370 million. So you remove that 150 million from the 370 million and apply the 30% to that post-acquisition retained earning. You have 66 million. Then you need also to calculate the retained earning from Nana in the indirect acquisition. As at the time the indirect acquisition took effect, the retained earning was 300 million. So you will remove the 300 million from the 370 million that is in the reporting date and remove it and apply 42%. So you have 29,750,000. If you add it up, the retained earning will be 438,250,000. It will end there. When we have done the adjustment, we'll reflect the adjustment on the retained earnings. Then we have reserves. The total reserve from NED will also be taken, which is 180 million. That's it. And then from Nelly, they had reserve of 50 million. They have reserve of 50 million in their statement of financial position. However, at the time of acquisition, they had 30 million. So you remove the 30 million and apply the 85%, you have 17 million. So you add it up, you have 197 because Nana does not have reserves. So with this now, we will go into adjustments so that we can now adjust them. I'm going to write out the balances in the non-controlling interest, the written goodwill, and the written earnings, and then apply all the adjustments. Okay, so I have brought the computation of the NCI, goodwill, and written earnings without adjustment. These are the way they were computed. So we added all these adjustments to arrive at these values. But we're going to look at how we arrived at the adjustments. Let's start with unrealized profits, which is this and this. According to the question, Nelly sold to Ned 100 million worth of goods at a markup of 25%. So sales is 100 million. And they said that a quarter is still left unsold, which is 1/4 of the 100 million to give you 25 million. The unrealized profit there will be 25% over 125 times that 25 million. This 25 million you are seeing here is not 100%, but is 125% because it's including the markup value. So it is 100% plus 25%. That's this figure. So that is why we do, instead of 25 over 100, we use 25 over 125% because this figure is 125% to arrive at the unrealized profit. Inventory in the shop. So we have to eliminate it. However, since it is the subsidiary that sold to the parent, what it means that part of the retained earning that was made, the profit, unrealized profit, will be attributable to non-controlling interests. So since we have 85%, we are going to take that 85% off retained earnings. And then we'll take the remaining 50% off non-controlling interest. Whereas we remove the entire 5,000 from the inventory. So that is why we have here non-controlling interest. We are removing 750, which is this. We also have retained earning. We are removing 4,250, which is this. Then there is intercompany transaction or intra-group transaction. Receivables was 20 million and payables was 25 million and goods in transit 5 million according to the question. So we're going to remove it from payables and receivables. So that is why we have to debit payable. Payable is a credit account. We have to debit it to remove it. Then goods in transit. Since the goods was removed before, but we have not received it, we have to bring it in. Then credit receivables to reduce the receivables. These are intercompany transactions which must be eliminated from the book. It will not be part of the thing of the amount being reported to the owners of the parents. Then we have to calculate the value of investment. Of course, investment as cost is 20 million. And there was a profit of 60 million. However, it was 25% we bought. So the 25% of the 60 million is 15 million. And tax was paid of 12 million. 25% of that 12 million is 3 million. So we'll remove it because it's reducing the value of investment. And then dividend again was paid 50% of the dividend paid of the profits. Profit was 15 million, 50% of it is 7.5 million. So the total value of investment is 24,500,000. Then impairments. Impairments, which is these two. For Nelly, they said the impairment was 5%. And for Nana, the impairment was 10%. For Nelly, we use 5% of 109 that we calculated in the Goodwill, 109,500, which will give us 5475. And then for Nana, it's 10%. Now we're going to add up the Goodwill of Nana to get the 10%, impairment, because the Goodwill of Nana is added together, both direct and indirect. So if you add the direct investment and indirect investment, the Goodwill will give you this plus this. 10% of it is this. So the impairment is going to reduce the Goodwill and the non-controlling interest. So that is why we are removing it. Then we now look at the dividend from the increase. Okay, I think I should call it increase from investment, which is the 20 million minus 24 million. It will give you 4.5 million. So in total, we have non-controlling interest of 238,075, Goodwill 324,075, retained earning 438,500. So right now we can consolidate. However, we still need to adjust in this question, we don't have receivables, we don't have payables, but we have current assets and we have current liabilities. These are inside them. So we're going to adjust them accordingly. The total current assets of the three companies in that group is 1.5 billion. The unrealized profits was 5 million. We're going to remove the payables of 20 million and then the goods in transit of 5 million. So we have 14770. Then in the current liabilities, we are going to remove as per the statement of financial position, the three companies total 830 million. In that place, we'll remove the receivables of 25 million. Remember, because of the way we did the journal, that's why I'm saying remove the receivables. What we're only saying is that we'll reduce payables by this amount, reduce receivables by this amount. So take it that way, since you have already seen the journal that I passed here. So if I say remove receivable, don't be confused. I'm only saying reduce receivable, reduce payable, and then add this, reduce goods in transit. So that's how it goes. Now, after doing this, the next thing we need to do is to now prepare the statement of financial position for NED PLC group. We won't have a problem again because we have done all the workings that we need to do. All we need to do is to add up all the PPEs of the companies. And then we have this values in transit. We already have the investment. Investment has changed from 20 million to 24 million 500. This is 500. Then we already worked out goodwill. This is our goodwill here. And then we have also worked out current assets, 1470. Then we have a total asset of 3468,575,000. Then the share capital, we will only take the parents' share capital, which is 600 million. And we'll only take the share premium of the parent also, which is 210 million. Of course, the revaluation surplus, we are going to take the parents and then the post-acquisition revaluation surplus, which we calculated at 17 million. So if you add it, it's 197 million. We already calculated them. Then the retained earnings, we have also calculated it is here, 438,500. The non-controlling interest, we have also calculated it is here, 438, 438,500, 238,075. Then we have the 15% loan notes. 15% loan notes, 470,000. The deferred tax, 350,000. Then the current asset, which we have also computed, is 805 million. At the end, you look at the statement of financial position, we have a balanced statement of financial position. Sorry, 468. Thank you for watching so far. To explain the error message that was showing on the video, the impairment that was used to reduce NCI was supposed to be used to reduce retained earnings. So please, we need to adjust it. That means we're going to take the impairment of nearly 5%, 5.475, and Nana 10% to 24.450 to retained earnings. So when we reduce the retained earnings will be 408,575 instead of 438,500. And then the NCI will increase to 268,000. We will make this correction. The total assets and total equity plus liabilities will still remain the same. So please, let us make this correction. That is the only correction that we have to make. So this is the solution of the 4 past questions that I promised to solve. Go through it, and then it will give you idea of what you are going to see whenever you are challenged with these topics. Ratio, business combination, group accounts, and investment in associates. At a time, we are going to take them one by one. I've already dealt with ratio fully in previous episodes. The next is that I'm going to treat these ones individually. So continue to like, continue to share, continue to follow us. Comment is very, very important so that we also will respond to you on what your problems are. Thank you as you follow us.